So, well, let's move on to let's see, Newell Brands.
Yeah.
Newell Brands. I like that name. That just sounds kind of cool. And I know we looked at this company years ago. We decided not to buy it. Said, it could have some problems. Those problems did develop, unfortunately, for the company. Newell Brands are symbol is NWL. They're in the household and personal products industry. Wow, the short on this is 16.9%. That's pretty high. Unfortunately, they have no PE ratio, which means no earnings. We do see the industry is at 25.1. Price of sales does look good, 0.2 versus 2.5. Price to book value, 0.5 versus 4.9. But I got to point out, price to tangible book value is not material. So if you take away the intangible assets, well, then there's no value there. Price of cash flow is 5.2 versus 16.8. PEG ratio looking pretty good, 0.7. Now, the last year, there's no earnings, so no earnings growth. The industry was up 5.6%. Sales were down 5.9% when the industry was up 1.3%. Going forward, the analysts seem to be optimistic about this because a 5-year earnings per share growth estimates a positive 10.2 when they see the industry a negative 9.7. So maybe the industry thinks this is going to turn around, or the analysts think this is going to turn around. You do get a 9% yield from this company now, but with no earnings, there's no payout ratio. The free cash flow payout ratio is a negative 500%, so that's not very good. Let's take a look at the balance sheet. Current ratio 1.1 versus 1. That's okay. Debt to equity a little bit heavy, 2 versus 1.2. Net profit margin is a negative 0.3%, while the industry stands at a positive 10.4. Return on equity also negative 0.9% versus positive 27.4. Free cash flow is a negative $20,000, I believe that is $20,000, but yet the industry is at $7.6 billion. I mean, this company just seems like they're struggling for some reason. I don't know if you have any answers to that, or maybe things change going forward with the earnings. What do you got there, Jason?
Yeah, I mean, this company, I mean, it plummeted. It looks like about 28% after reporting quarterly results that definitely missed expectations. It looks like guidance was really what took it down. They were looking for 56 to 60 cents per share, and that was down from a prior forecast of 66 to 70 cents. So that's quite a sizable cut. And they also see revenue declining by as much as 5% versus prior guidance of a 2 to 4% drop. So you don't want to see weaker earnings and declining sales. That's not a good combo. And the numbers here for Newell Brands, I mean, it's interesting. I mean, current price here is $3.11. Again, their ticker symbol NWL. And I say it's interesting because the 52-week range, the low $3.07 and the high $11.78. I mean, year to date, the stock is down 68%. Over the last 5 years, you're down 83%. Over the last 10 years, you're down 92%. I mean, it just gets worse and worse the further you go back. And you go forward, I mean, there's value here in terms of the earnings. You got to December 2026, estimated earnings per share is 64 cents. It gives you a target sell at $10.62. It trades at a forward P of about 5. I mean, that's pretty intriguing. But the problem is I worry about negative free cash flow, a weak balance sheet. I mean, this company could turn around or could go bankrupt.
And also, I see there's 11 analysts that come up with that number. The range is very high. It's a low estimate of 39 cents, a high of 85 cents. If you take 39 cents, you probably get a stock price somewhere around, $4 and change, probably.
Yeah, and I mean, I want to like it because it's got good brands. You know, it's got the Graco. Graco's the baby company. Oh, yeah. You have Coleman, which is the camping equipment. You have Rubbermaid, which is, your Tupperware. And they also have, trash cans. It looks like commercial products. Yankee Candle. Talk about Sharpie, Elmer's Glue, Papermate, the pen company. I mean, they have, decent brands. It just seems like maybe it was poorly managed and the debt fueled it to a dangerous place. That's
what I was thinking. They need Tim Cook to leave Apple, come over there and run the operations, because it looks like this company has good potential. You know what we could see with this is a corporate raider or something happens, somebody come in and take this company over, because they've got, I believe, some great products that are household names. Why the stock is at this level, why it's doing what it's doing, it's got to be mismanagement.
Yeah, I mean, this could be something that private equity could look at and take it private and turn it around, clean up the balance sheet, and make good money off.
Yep, I think you're right.